I just quickly go through what we discussed about fixed income last week. Just to remind you, we discussed about what is a fixed income security, and it's an obligation of an entity and promises to pay a certain amount on a fixed future date, and there may be interim interest income as well. So the amount that the issuer, the borrowing party, promises to pay on the maturity date, we call it or the maturity date, or maybe even before that, we call it the principal value. What's the amount the issuer or the borrower promises to pay? We call it the face value or redemption value or maturity value. Then the investor is the party who lend money buying this fixed income security. The reason that we call them fixed income securities because there's a fixed interest income most of the in general. Yes. Now, even though within that there may be small variations, as we discussed, floating rate note or step up, step down, coupon rate, those variations will be there. Maturity is the time period or the date exactly. Maturity date is the date where this bond comes to non-existence or cease to exist. So after that, there's no obligation. By that date, the issuer should meet its all liabilities with regard to this bond issue. Par value, principal value, face value, as I mentioned, the same thing. There can be different redemptions. Bullet maturity, that means the whole amount, whole principal amount will be paid at the end on the maturity date as a lump sum. But there can be callable bonds and puttable bonds. Callable bonds, the issuer has an option to redeem the bond before the maturity date based on a pre-specified schedule. We call it call schedule. Puttable bonds, that option is available with the investors. They can ask their money back before the specified maturity date, but again based on a given agreement. All these conditions are mentioned in the bond agreement. We call it covenants. What are the terms and conditions of the bond? Or there can be serial redemption in different time frames. Different amount are paid, and there may be some bonds no redemption, that is perpetual. You get only the interest income, fixed interest income regularly forever. Convertible bonds are the bonds that you can investor can convert it into equity or shares of the issuing company. Again, there will be a time frame on which date the investor can convert, or after that, anytime investors can convert it into shares. Then the coupon rate is the interest rate, annual interest rate the issuer agrees to pay on the face value. The interest is paid regularly based on the coupon rate and the face value. That is called coupon rate. The interest amount we call coupon. Based on the coupon rate, and the face value and the frequency of payments, interest payments, how many, oh, yes, how many times the issuer is going to pay interest within a year. That's the frequency, depending on those three factors. That means, again, coupon rate, frequency, and the face value. We can calculate the coupon amount. That means what is the interest amount that the issuer is going to pay on each coupon date. Coupon date is the date on which the issuer pays the coupon interest payment. So based on the coupon rates, again, we can divide fixed income securities or bonds into different categories. Fixed rate bonds, that means the coupon rate is unchanged. It remains same during the lifetime of the bond or during the period until maturity. The coupon rate is fixed. And in the floating rate or variable rate notes, time to time, the coupon rate may change. There may be an agreed formula how to change this coupon rate. And this is an example we discussed. The zero coupon bonds means like treasury bills, no coupon, issue date, and cash flows are occurred only on the issue date and on the maturity date. Issuer will borrow some amount on the issue date and on the maturity date pay back the agreed face value. So whatever the difference is the interest income for the investors. There's no interim cash flows in between issue date and the maturity date. Very similar, this is equivalent to a treasury bill. Only thing is maturity period or the lifetime of a bond is more than zero coupon bond is more than 1 year. Less than 1 year, we call them as bills or commercial papers. If it is issued by a private entity, if it is issued by a government, we call treasury bills. But when it comes to an instrument with a maturity of more than 1 year, we call them as zero coupon bonds. So then we discuss about how to calculate coupon given the face value, coupon rate, and the coupon frequency. So we did some calculation. Is it clear? Up to this we discussed last week. Any question on this? Remember, so this coupon is the coupon paid on a particular coupon date. So this is not the coupon or the interest paid by the issuer for a or within a year. It's not like that. What's the amount of coupon or the interest paid by the issuer within a year? It may be multiple of these depending on the coupon frequency. In this case, coupon frequency is 2. So therefore, instead of 45 million, issuer pays 90 million of 90 million rupees as interest within a year. This is the amount the issuer pays on a single coupon payment date. So there are 2 such payments for this particular bond because coupon frequency is 2 or it is paid every 6 months. So then the price. Shall I move forward or you have any questions?
So can you just go to the previous screen for a minute, please? Thank you. Thank you, sir.
Shall I move forward?
Yes, go ahead.
Yes, remind me. In the handouts, I think some of these are not there. You have to note it down. So if you don't have enough time, just tell me. I'll keep it for or hold it for a while. Then you can note down. What is the price? The price is the amount that the investor pays when the investor buys this bond or any bond or at the issuance. Is it clear? So that's not the price is not the amount that you are going to get at the end. It may be or it may not. But generally we quote the price as a percentage of the face value. This is the amount that you are going to pay when you are going to buy a bond. It may be different from the face value or it may be same as the face value. How do we decide the price? It is equals to the present value of future cash flows. So that's why I ask you to revise or refresh your knowledge on how to calculate present value and future value, because when we discuss in a moment, we are going to discuss how do we price a bond. We need this concept, calculating present value. So basically price is the present value of future cash flows of the bond. That means all the coupon payments and the maturity proceeds. So depending on the required rate of return, the price may be equal to face value or maybe less than that or maybe more than that. But in general, the price is quoted as a percentage of the face value. So based on the prices, we use two words to identify whether the price is less than the face value or price is more than the face value. When we say discount, we said the bond is traded at a discount price. That means price of the bond is less than its par value or its face value. But in the premium, it's other way around. Then the price that you pay is more than the face value. Is it clear? Discount, like in a treasury bill, you don't pay face value, you pay less than that. So that's in that case, we trade the bond at a discount. When the bond is trading at a premium, the buyer has to pay more than the face value. In this picture, you can see it properly. This is the line, par value of the bond. There can be a bond which is traded below the par. The price is less than par value or the face value. Then we said that bond is trading at a discount. There may be bonds where you have to pay price more than face value. Then we call it trading at a premium or trade at above par. Or depending on if it is a discount, we call it below par. Is it clear? Whether you pay a premium or you get a discount. What do you mean by paying a premium? You pay little bit more. You pay or you get a discount means you pay less. Compared to what? Compared to par value of the bond or the face value of the bond.
Here, par value directly directly refers to the face value, no, Mr. Nishant?
Yes, par value, face value, maturity value, redeem value, all are the same. Sometimes we call it par value, sometimes we call it face value. Most probably in the future I use the word face value. Anything else? Okay, so before we move into how to calculate price and other relevant other relevant calculation, I just thought to show you about few bonds and key characteristics. This is a from Bloomberg screenshot. For a particular bond, you can see here SRI LGB 9.85 9/15 24. SRI LGB is we call it the ticker, the short name given in Bloomberg to identify Sri Lanka government bonds denominated in rupees. Then 9.85 is the coupon, and this is the maturity date. Remember, what is this date? 9/15/24. Even in Excel, there are different date formats. The date format used in Bloomberg and Excel as well, unless you change it, the first comes the month, then the date, and then the year. So what does it mean then? September 15th, 2020. The maturity date is September 15th, 2024. So in this table, you can see all other information. Name, issuer information. You can see issuer information. Name, Sri Lanka government bond. So this is a Sri Lanka government bond. Industry class. This is bond class. This is based on Bloomberg classification. Don't worry. Then the market of issue. It's in the domestic market. Country, regulator, Lanka. What is the currency? LKR. Then there can be series A and B. So it is mentioned. Again, here also it says coupon is 9.85, type fixed. That means this coupon is a fixed coupon. The other coupon frequency. Can you see here? Coupon frequency SA. What does it mean?
Semi-annual, no?
Semi-annual. Coupons are paid. Yes, coupons are paid twice a year.
Why does it rank as unsecured, sir?
Unsecured means there's no asset back to this issue. There can be secured bonds as well, or secured by a particular asset or cash flow or something like that. Then the day count convention. We discuss about day count conventions. So in Sri Lanka, for bonds, we use actual. Whenever you calculate interest income, you consider the actual number of days for that particular period and the actual number of days for that particular year. Then maturity date, again it's mentioned. Bullet, what does it mean that this bullet? The maturity is a bullet maturity. That means you get the whole principal value on the maturity date. Can you remember I explained different redemptions. So this bullet maturity, it is specified in that. Then issue yield will come back to this. Then it says other convention, calculate conventions. There are different conventions of calculating. What is the pricing date? Interest accrual date, on which day and onwards the interest accrual starting. First settlement date and the first coupon date. And there can be different identifiers, unique numbers. Can you remember we discussed about icing? Icing is here. There can be other identifiers used by different agencies, but globally accepted IDs. Those will be here. Generally in bond ratings, credit rating of the bonds is appeared here. Then the issuance and trading, you can see here amount issued and outstanding. In this bond, amount issued is this. M means you have to multiply this again by 1000. Then it become 14 billion something plus something. And this is minimum piece. It should be minimum 5 million. Then you can trade increment in 1 million. The minimum you can trade is 5 million. Then you can increase it 1 million. Par amount, see, par amount is 1 million.
Sir, why do you have to
For a
multiply
particular single bond. Sorry?
Yeah, why do you have to multiply it by 1000? Does it traded in 1000 lots? So why does it?
What do you mean by multiplied by 1000? No. This M,
Yeah.
that's the convention that the Bloomberg use, since they cannot maybe put long numbers here.
Okay.
Just sometimes they indicate double M. That means you have to multiply it by 2 times 1000 into 1000. That means 1 million.
Okay, thank you.
Does it indicate the millions? In other words, Mishnanta?
Yes.
Millions, no?
Millions. No. It not indicate millions, no. Then if it indicates million, how do you call it? This is already there's 147 million and 850,000 millions. Then you have to multiply this by millions. This doesn't indicate millions. Sorry. You have to just multiply this by another 1000.
1000, no?
Yeah.
So another small concern. So
Yes.
if the minimum piece is 5 million, why it dividing into 1 million pieces?
No. Minimum quantity that you can trade 5 million. Then the next level may be 6 million or 7 million. Increments is
Adding 1 million to the minimum amount, right?
Yes.
Right. Okay. Thank you.
You can't trade 4 million or something like that.
Above 5 million.
Above 5 million, but
and
then
plus
multiples of 1 million.
Right. Okay. Thank you, sir.
But this is applicable only for the whole trade, wholesale market. But So
What does it mean, par amount, sir?
par amount is the, say, now, that's a good question. Now, say, this whatever this number, this is the amount in rupees on the maturity date. What is the amount that you are going to get? But different investors invest in different amounts. Then what is the number of bonds that you get is the that may be different. A single series consists of particular number of bonds. What is the face value of a single bond? Single bond. It's like we call pen. Say pen. Price of a pen is 10. But if you say 10 or 20 or 50 or whatever, say in a box of pen there can be say 100 pens. Then we sell it as a box. Likewise, in bonds also, there's a concept called single bond. It doesn't mean the whole issue, but pieces of that bond. The minimum piece is 1. Face value of that piece is 1 million. If you want to buy 5 million worth of bonds, that means you buy 5 bonds. You buy 5 bonds, then you get face value of 5 million, because face value of or the par amount of a single bond is 1 million.
So that pricing date means that is auction date, no?
Yes.
Interest accrual date means value date.
No, first settle date is the value date. Settlement date.
Yes, settlement.
Yes. Probably, generally, most of the time, interest accrual date and the first settle date would be the same. In this case, I think September 15th is a holiday. So therefore, you have to settle it
In next day, no?
Next day. That's why it's there. But say bond like this one, you can see settlement date 17th May 2021, but the date of maturity 1st of May 2025. So in this bond, if you can get the description, it would say interest accrual date is 1st May 2025, first settlement date 17th. Sorry, interest accrual date is 1st May 2021, 1st of May 2021, and the settlement date is 17th May 2021. Did you get it? Because this is settled after 1st of May, the coupon cycle. Because every 6 months the coupon is paid, so therefore first interest accrual date should be 1st May, but the bond is settled 17th May. I draw a timeline in this way. This is first of May. Then the next, what is the next coupon date? First of November. This is the coupon cycle because the maturity date is 1st of May 2025. We discussed this last week as well. So, but somewhere here is the settlement date. So the interest accrual date would be 1st May 2021, and this would be the settlement date. So you start accruing interest from this date, and the interest will be paid on, next coupon will be paid on this date. But first time the bond will be settled on this date.
So this is because this ICN series is already issued one, no?
If it is already issued one, the first settlement date and the interest accrual date would
Same,
be
no?
1st May, whatever the year. If it is 2020, it may be 1st May 2020. If it is not, if this is a fresh series, this would be the way. In the description, you would see this is the first, sorry, interest accrual date. This is the settlement date.
Sir, can you explain that again? I didn't get that.
Yes, because in this bond, it says settlement is 17th May, but the maturity is 1st May 2025. So every 6 months there will be coupon. Say this is 1st of May. Okay, I think it's easy if I go to Excel without trying to draw here.
Mr. Chand, that is basically the first interest accrual starting date for my next coupon, is it?
No, not the next coupon.
For my first coupon?
No, let me show you. Okay, it's like this thing. This is so 1st May 2021. What is the next 6 months? Okay, no, we'll start here. Maturity date is
1st May 2025, sir.
2025. Okay, what is if you come back 6 months from this date, because this is the maturity date. Coupons are paid every 6 months. So what is the one before last coupon date?
1st of November.
1st of November 2024. This is 2025.
Yes.
So the one before the last is
Yes, 24.
1st November
24.
4. If you come like this, there will be 2 dates like this. November 1st and the May 1st. But now we are somewhere in between. 17th May. This is the settlement date. This is the first settlement date. This is first coupon date. Correct? To maintain this cycle, the first coupon date should be November 1st, 2021. But the bond is settled for the first time. It is settled on 17th May. So then what we use, from the first coupon date, we go back 6 months, find out what would be the corresponding date. So it would be May 5th, 2021. This is the interest accrual date. So we start accruing, assuming it's like we hypothetically assume we issue the bond this date and interest is accrued from this date. That's what we do. So then the next coupon is paid on this date. But actually the bond is issued on 17th. Is it clear?
But sir, when you purchase this bond on 17th May, that you are eligible only for the interest in between 17 to November 1st, no?
Yes, you are eligible for the interest for this period because you are buying this bond on this day.
Yes.
You are eligible only for this period, but you will get the full coupon here. Okay, we'll go back and I'll explain. Remind me, can you remember I asked you to remind me this one, how to do
yes.
So I'll explain once we discuss about the concept called accrued interest. Then I'll explain. So we are going to discuss this accrued interest in a moment. Then I'll explain what do you do. So this is there any other question on this?
So in this issuance and trading, it means have to multiply by 1,000, no?
1,000,
Okay.
yes.
Okay, so thank you.
Okay. Don't worry about this. This is if you are going to use Bloomberg only, that you have to use this. But in this, say, in this it's clear what is the accepted amount. Say rupees million, 10,000. That means what is the amount? 10
billion, no?
10 billion.
Sir, when you're buying this, is there like a minimum amount that you have to subscribe to? Is there like a lot, like how many number of pieces you have to buy? Is there like something like that, or you can buy even one bond?
Not from the primary market. So basically, what it says here, you can buy minimum this one, 5 million. You cannot buy one.
Goes in 1 million increments.
Then goes in 1 million size. It increases. Minimum 5 million, then 6 million, 7 million, 8 million, 9 million, 10 million, like that.
Okay, thank you, sir.
So, but there will be specific rules given by the public debt department in the how you should bid in the primary auction. Please go through those things to get more information.
Sure, sir. Thank you.
They have different set of rules in that. This one, another example, this is, you can see issuer US Treasury. So this is a bond issued by US government. The ticker is, they just use Treasury T. The coupon is 1.625. The way it's written here is slightly different. So what does it mean? 508. If you convert that 508 into decimals, it would become 1.6. It is equal to 1.625. And this is the maturity date, May 15th, 2031. Sorry, if I go back to this, you can see two figures here. This is the yield. This is the price. Say, I mentioned that we quote price as a percentage. So 109.337 as a percentage of the face value. So whatever the face value, you can calculate the real price by multiplying this percentage. And this is the rate of return. We call it yield. Will come to, you will come to know that later. This is the price. Why do we have two prices?
That is bid and offer.
Bid and offer. The left hand side is the bid, right hand side is the offer. So at,
For the yield is same, no?
yes, for the yield also same. Okay. At what price you can buy if you are a market taker?
The offer, right?
Yes. That means what's the price?
109.675.
Yes. You can buy it at 109.675. If you sell, you can sell it at 109.337 if you are a price taker. If you are the price maker, it's other way around. You buy at 337 and sell at 675. So even here you can see the same, only difference is the price comes first and the yield comes second. Again, the way they show the price is slightly different. This 20 means, does anyone know what does it mean? This 20. For some historical reasons, they use them as 30 seconds. It's 20 over 32. If you want to convert it into a decimal, that's the figure. 20 over 32. This is 21 over 32. Then you get the decimal figure. That's their convention. Don't worry. So then again, you can see this one also the same. Issue date is May 17, 2021. And the interest accrual date is May 15th, 2021. There's a gap of 2 days. Then the first coupon date, November 15th. Maturity date, May 15th, 2031. You can see coupon date, coupon frequency, semi-annual, type is fixed, calculation type, street convention as in our one as well, day count, actual, country US, currency, USD, tenders accepted. That see, you can see now two M's. In this, you can see the issue price at the issuance, what is at the primary auction, at what price they issue it, and other some details, even the IC numbers. If you want to find out more details by clicking any of these, you can get to know other details, even the credit ratings. So if you click this, it will show you the rating of the issuer. It is there in our one as well. See, bond ratings, what are the terms and conditions, governance. When you click this issuer description, it will show you about description about government, Sri Lanka government, here about US government and things like that. The third one is another example. I just wanted to show you different day count conventions. So you can see here it's 30,360, but this is a bond. GE Capital International Funding. What does it mean? GE means General Electricals. They have their finance arm, different finance arm, finance company. This is a bond issued by this. That's why it says here corporate. This is not a government. It's a corporate issue. 0.418 is the coupon. November 15th, 2035 is the maturity date. It should be there. Maturity date. And bullet. Coupon type is fixed. Currency dollar. Coupon frequency. Pricing date. Interest accrual date. First settlement date. And first coupon date. All those details are also there. Issue size, minimum quantity, ratings. Here you can see the ratings. All those information there. Here, especially what I wanted to highlight, different day count conventions, because when we discuss this accrued interest, we need that day count convention. We discussed that at the very beginning. We discussed about how do we decide maturity days and how do we calculate different interest, and money market day count conventions are different from bond market day count conventions. I think you can remember those. So most of the time in the world, most of the government bonds are issued actual basis. So what is the accrued interest? Have you ever heard about the word accrued interest?
That's a interest accrued on the bond, right?
Yes. What does it mean by accrued?
So is it the amount that is accrued up to the current day?
So what is the interest so far that you have earned but not paid? That's the difference. You have earned the interest, but it's not paid yet. Say this is the issue date. This is the issue date, or that can be last coupon date and the next coupon date. So this is the date in between these two coupon dates, or the first issue date and the coupon date. If you buy the bond here, and you keep it until this date, and you are going to sell it here. Sell it on this date. That's a settlement date basis, not the trade date basis. This is the, you enter into a sell transaction and you are going to sell it to someone else on this date. Ownership is transferred or the transaction is settled on this date. Do you get any interest income from the issuer on this date? Will the issuer pay you the interest that you earn, hold it until this period? It won't happen. The issuer will pay the coupon on this date, the person, whoever who holds the bond on this date. But if you sell it on this date, you don't get any compensation for this period, because now ownership is transferred to the other party. If that party holds it until this date, that party will get the coupon. So in bond markets, what do? We calculate what is the interest income the buyer should, at this point buyer, but at this point seller. The seller should get from the last coupon date. What is the interest that he or she has earned so far from the last coupon date to today? That is, we call the accrued interest. This concept is applicable even for any other financial instrument, even for a loan. So if you do accounting, you know the accounting is based on the accrual basis, not based on the cash flow. So whatever the amount that you have earned, you calculate for that period and you call it the accrued interest. So the same concept here. But practically, why do we need this? Bonds can be traded at any time during its lifetime or any time in between two coupon dates. So the seller must be compensated for his holding period of this bond. He should get the interest component of his holding period. So therefore we calculate the accrued interest, and it is paid by the buyer to the seller on the settlement date. So is it clear?
So what is in the clean price and dirty price thing?
Yeah,
So,
I'll come to that as well.
yeah.
So just is it clear what is the concept accrued interest?
That means that at the first coupon date, that new buyer will get the entire coupon from
Yes,
the
yes.
central bank.
Yes.
But when you are purchasing the bond, that you have to give that accrued interest to the seller, no?
Yes. So with that, if I go back to this, what would happen in this case? This is 1st of May. This is 17th. This is 1st of November. So the bond is settled on 17th. But buyer, if he holds it until this date, or whoever buyer holds it on this date, he will get 45 45 million. That means the interest for the whole period. That was the concern that you had earlier. The buyer or the government will pay the coupon for the whole period, but you purchase only on that date. So you are indeed you are entitled only for this period. You are entitled for interest only for this period, but you are paid for the whole period. What do? On this date, 17th May, you calculate if it was there, what would be the accrued interest. So remember, in this course, AI means accrued interest, not artificial intelligence. So we calculate the accrued interest, assuming the bond is issued on 1st May and the coupon rate is 9%. There are 17 days here. Is it correct? 1st of November to 1st of May to 17th May. There are 17 days. So what would be the accrued amount, accrued interest for these 17 days? Whoever the party that buy this bond on this on 17th, that party pays this accrued interest to the government. When you buy it, you pay this accrued interest, and at the end you will get it back because the whole coupon is paid by the government. That's how you settle this transaction. Is it clear now? The concern that you had, because you are entitled only for this period, but the government is going to pay the whole coupon on the first coupon date. That is because at the time of purchase, you pay this accrued interest amount to the government. Then you will get it back on the next coupon date. So basically you don't lose anything other than very small time value of money.
It will be discounted from your purchase price, no, sir?
Yes, sorry?
It will be discounted from your purchase price, no? That accrued interest?
No,
For the
no,
17
no,
days?
no. Based on the yield, you calculate the price and then add the accrued interest, you pay that. It's not discounted, you add to the price.
Yes, right, at yes.
So this is the same concept applicable even in the secondary market. Assume this is 1st of November 2022, and you do a trade to settle on 17th May 2022. This is 1st of November 2022. The buyer on this date has to pay this accrued interest amount to the seller.
If someone is buying on 20th May 2021, so he'll have to pay the entire 20 days accrued interest to the seller, right?
Seller. Yes. If it is 20th May, yes, then you have to pay for the whole 20 days. Okay, assume one party purchase is it's on 17th. By the time when he's buying that on 17th, he has to pay accrued interest for 17 days. Correct?
Yes.
Then he decided to sell it on 20th. then the new buyer, the second buyer has to pay accrued interest for 20 days. But the first buyer already has paid for 17 days. Then the net would be accrued interest for 3 days. Did you get it? First buyer pays accrued interest for 17 days.
Yeah, but when the second buyer has to pay the accrued interest of 20 days to the first buyer, right?
No.
Because
Yes, first buyer. Yes.
okay.
But he has already paid it accrued interest for
17 days to the government issue.
17 days to the government, since this is a primary auction. So the net
So
income
he's
for his only for these
3 days.
3 days.
Yeah.
Clear? Is it clear? So if the second buyer holds it until this date, he will get the whole coupon income, which includes accrued interest for 20 days, which is paid to the seller. So that's the accrued interest from a last coupon date. From the last coupon date to the settlement date, what is the interest income earned by the bondholder? Whoever the holder, what is the interest income earned but not paid yet? But when we settle it in between coupon dates, the seller has to pay it to the buyer. So how do we calculate the accrued interest? This is the formula. So basically, what is this part? Face value into coupon rate divided by coupon frequency. What is this?
Coupon, right?
That's the coupon. Yes, exactly. If you go back to the coupon equation, you can see face value coupon rate divided by frequency. So that's the coupon. So doesn't matter how many number of days are in between the relevant coupon period. What we do, we first calculate the coupon. That's what we do. Then that coupon amount is prorate based on the number of days in that particular coupon period. Days from last coupon date to the settlement date and the number of days in current coupon period. What does it mean? If we go back our example, this is 1st of May. This is first of November. This is our coupon period. So for a 9% semi-annual coupon period, the whole coupon would be 45 million as we calculate earlier. Is it clear? The whole coupon period, coupon would be, or the coupon is 45 million. We get it through this. Doesn't matter how many number of days are there in between 1st of May to 1st of November. But say this is 17th May. Now, for the whole period, coupon is 45 million. It comes from to this part. Now what do we do? Depending on the number of days in this period, number of days from 1st of May to 1st of November, we prorate this 45 million to this, how many days here? 17 days. So this would be 17. Can someone tell me how many number of days in the current coupon period? What is the current coupon period? 1st of May to 1st of November. How many days are there?
180 days.
182. So this 45 million into 17 divided by 182. That's the total accrued interest amount for this period. That's how we calculate it. So now you can see this is 100. If this is 182. The next semi-annual period, what's the number of days in that? 1st of November to 1st of May. First of November to 1st of May, how many days?
183.
183. So now you can see if someone holds 17 days starting from 1st of November, for that period accrued interest would be slightly lower than the accrued interest that you earn in this period. Because for the whole coupon period, we don't consider whether it's a 182 days or 183 days. We just consider it as a half of the year. That's why we just divide it by 2, coupon frequency 2, multiplied by coupon rate and face value. Whether it's a 6-month period with 182 days or 183 days, the coupon is 45 million. Is it clear? Irrespective of the number of days in that particular coupon period, coupon amount is the same. If you take 2 semi-annual periods, you get same coupon. But for the same number of days in these 2 semi-annual periods, accrued interest amount would vary depending on the number of days in that particular coupon period.
So, but this would be if it is actual by actual.
Yes,
right?
yes, depending on the actual or actual. But whatever the day count base is, this part is true. Huh? The second part is depending on whether we go by actual or 3360 or actual 365. So accrued interest, this is another example that I'm going to do almost the same thing. No, different. 15th January. Last coupon date is 15th January. Settlement date is 31st May, face value is 1 billion rupees, coupon rate is 9%. Then what is the accrued interest? So first thing, you have to decide the three key days. What is this? First one, last coupon date, then the settlement date. What is the settlement date? And what is the next coupon date? So if you go back, next coupon date is not given. Last coupon date is given. 15th January 2021. Then what is the next coupon date, assuming semi-annual? If the last coupon date is 15th January, next coupon date is
July 15?
July 15.
15, 20, 21.
Yes. So that you have to derive. Next coupon date is July 15th, 2021. The settlement date is given depending on the agreement between two parties. Now, to calculate the accrued interest, what do we have to calculate? First thing, we should know coupon rate is given, face value is given, then we can calculate the coupon amount for this particular period if you need, or we can straight away calculate the accrued interest with the other information. So the first thing we need, how many number of days in between January 15th and July 15th? Can someone tell me how many number of days? How do you calculate it? You know how to use Excel. January 15, 2020. Then July 15, 2021. What you have to do in Excel, just subtract or take the difference. 181 days, correct? Just enter the 2 days. Remember, in Excel by default, the date format is month, date, and the year. So what I do, I'm not going to change the date format, but I remember in Excel, this is the way it works. So I use that. If you want, you can change the date format and enter the date accordingly. But rather than that, it's easy to remember the convention and follow it. So 181 days. If you have to do it manually, what do you do?
Hello, sir.
Yes.
So in exam, we can't use Excel, no. So in manually,
That you will have to do it most probably. Yes.
we have to.
How do you do it manually? Are you going to count daily January 15, 16, 17, 18, 19, like that? Okay.
You decide the number of days in each month and add it up.
Yes. So from January 15th to January 30th, how many days?
15.
So I'll go back to Excel. It's easy for me. So it's like January, February, March, you don't want to, you don't have to do this. If you do it manually, you don't have to write January, February, March, April, May, June, July. This is just for you to understand it. January, what's the, how many remaining days? So the last coupon date is 15th January. So how many days remain in the month of January?
16 days.
16 days. In February,
28.
in 2021, 28. In March,
31.
31.
30.
April, 30. May,
31.
31. June,
30,
30.
30.
In July,
15,
14.
that's the thing. 14 or 15.
15.
15. Okay. Okay. Then if we add these numbers, what's the number we should get?
181.
So let's see. $181. Is it correct? Someone says 14. Why?
That is that coupon date will not encounter, no, sir?
Exactly. What went wrong then? If you put 14 here, you won't get 180.
We counted January from 15. Yes.
Yes, that's the thing. From January, we have to take that if 15, because the coupon is paid on 15. Yes, as you mentioned, we did the mistake on January. How many days should it be? It's only it should be 17. Why? January 15 is the okay. Now you can see this. I'll explain first July story. You can see my screen, the calendar. Can you?
Yes.
Yes. Okay. July 15th is the coupon date. What does it mean? Within the day 15th, you get the cash flow. So will you accrue any interest on 15th? Are you? No.
No.
You get cash on 15th. So you cannot count 15. So then in the month of July, you have only first, because you keep money with them, that party on the first. That means from first to second, you count one day. Second to third, you count second day. Likewise, if you count, there are only 14 nights. If you count how many nights there are only 14 nights. Before the 15th night, you get your money. Correct? So therefore, July, there's only 14 days. If you go back to January, since 15, still the same, because there are 31 days even in January and July, we can use the same thing. On 15th, you receive cash for the last period. But for the next period, then you should count 15th. You earn interest for 15th to 16th, this overnight period. Likewise, if you count, there should be 17 days here. But the way you do it, it won't have an impact on the final count, but be careful. Is it clear? So it's simple like this. If you place a deposit for one day today, When do you get your money back? I think I explained this in the day count when we discuss about day count and calculation of interest. If you place a deposit for a 1 day, when do you get it?
Tomorrow.
Tomorrow. So from today to tomorrow, you calculate 1 day, not today, 6th of July, you consider as a 1 day. From 6th to 7th, you count 1 day. You get cash on 7th. Then you don't earn any interest for 7th. If it is a 1 day deposit, you place today. So go by that basis. Is it clear? Is it clear?
Yes, sir. But if the day count basis is by 30 by 360 or actual by 360, you don't count the 31st, right?
No. Even if it is 3360 for a say, okay, go back. If it is 3360, even for January you count 17 days, but February you count 30. All other months, full months, you count as 30. This would be the
Okay, so every month you get as
every
30.
month, because how many days that you are going to get count for the January? You don't
Yeah.
consider the whole month. In that case, you count that actual number of days.
Okay.
So then tell me, then what we need, what else we need? We calculate the number of days for the whole coupon period. Then what we need? Based on the equation, this 181 is the number of days in current coupon period. Someone earlier says, this 1st of May. Okay, fine. We now we calculated this. What we need days from the last coupon date to settlement date. That means we need number of days between January 15th to May 31st. How many days? How many days between January 15th to May 31st?
137. 37, sir.
So can you remember most of the at the beginning also I mentioned, so do these things by yourself, then only you will come up with problems and issues that you will face when you are going to do these things. If you don't do that even in the previous one by yourself, you don't realize whether the day count, whether the method that you are using is correct, or what are the problems that you encounter. So do it by yourself. I can do it easily and put all numbers here and give it to you or show to you. So that's why I deleted all these things from in the presentation handout what I sent to you. Now you have to work out and do things, then only you get to know these things. Even for me, it's easy. Prepare the presentation, send it. Now I have to maintain two versions. First do this and again delete unnecessary things and send it. So but I did that. So now it's up to you. Do it by yourself. Now I have explained what to do. Do it by yourself and see whether you get the correct answers. Because I'm pretty sure once you finish this class, you are not going to do this again until next week, isn't it? So during the class, try to do all those things without try to note it down and thinking I'll do this calculation later. Don't do that. I'm giving you enough time. I'm asking you to do, so do it now by yourself and try to identify what are the weak points where you are going wrong. Identify your weaknesses or the mistakes, that common mistakes that you do. Okay, how many number of days between January 15th and May 31st? And again, thing is whether we count January 15, yes or no.
Yes, sir, it should be 17 days for January.
Yes, we count January 15. Are we going to count May 31st? No,
No.
we are not going to count May 31st, but we count January 15th. Okay, how many days?
The month 36.
Sorry?
136.
136.
136.
So I hope you all got these numbers. So go back to the equation. This is the equation. You can remember face value is 1 billion. Coupon rate is 9%. Coupon frequency semi-annual, that means coupon frequency 2. So substitute the numbers and tell me the answer. And again, I remind you, practice your calculator. You should know how to key these numbers into the calculator in the proper order. Otherwise, you won't get the correct answer.
Thirty-three 813 000.
33 8 1 3 000.
000.
This is not the decimal point, no?
No, sir.
Okay. 33,813,000. So there should be, or can be a correct answer, because it it cannot be more than 45,000 million, because the coupon is 45 million in this case, and 136 days is gone, only 45 days remaining. Yes, it should be close to that side, more than 50%.
So shall
So
we?
this is semi-annually paid?
Yes.
Okay.
So shall we cross-check in Excel also?
Yes, we can do that. Any other answers?
Was this answer is rounded up or is that the answer?
I'm
With zero-
getting
That's why, yeah, you tell me your answer, whether this is correct or not.
I'm getting 33,812,154 cents 68.
Yeah, I also got the same answer.
yeah, I had the same.
1 2
No, yeah,
154.
12154
1 5 4
68 cents 68.
6 6
Yes.
8. I think yes, it should be something like that. It's very rare chance that you get a exact figure. Okay. Any other answers? If not, we'll see. Have you put these numbers properly like this?
Yeah.
Remember, coupon rate is 9%, so you have to include it as a decimal, 0.09. Coupon frequency 2 divided by 2, 136 or 181. So this is why what I got 154 6870. Yes, maybe in the Excel it's rounded off. 68 may be the correct answer. So we can do that in Excel. I don't want any of these. We can put coupon rate 9%. Frequency to face value 1 billion. Last coupon date, was it 1st of January? Yes, no, 5th. It was 15th January. 15th January 15th, 2021. Settlement date 31st May 2021. It's coupon date July 15th, 2021. Then number of days, coupon period from last coupon. What's the coupon period number of days? It's July 15th minus January 15th. From last coupon, settlement date minus last coupon. So the accrued interest, we can go straight away. Face value into coupon rate divided by 100 into frequency divided by frequency. Divided by frequency into number of days in between the last settlement, last coupon date to the current settlement date, divide by the number of days in the coupon period. Something wrong. What happened?
So reduce the decimals and see.
So put the comma in number group.
Put the comma in
Number group.
let's
It may be
see.
so as the date format.
That's in the date format.
Date format, that's a problem. Excel, it gives 69613. The problem that you get 68 is you did say 181 divided by 136 divided by this one.
Yes, sir.
You did this calculation separately.
Yeah.
Then you round off. You rounded off to 2 decimal places or 3 decimal places. That's why you get 68. So better don't do. You use the calculator. Try to get the full answer in the calculation, or at least use 7-8 decimal places. You can set the calculator to remember whether 2 decimal places or 6 decimal, whatever the number of decimal places that you use. That depends on your calculator. That's why you get these differences. 6, 8, 6, 9, things like. But the way you did it, correct.
So, sir, we will
So
will
remember.
get the full marks. No?
Sorry.
We will not get the full marks, no. If we
No,
that.
don't worry that one. If you are definitely for this you won't get the marks, but this you will get.
Okay.
Because the best thing is don't round off anything until you get the final answer. You try to keep it as it is. So the way we do it in Excel, is it clear for you? If you have to do this sort of calculation, just prepare a template like this. Then whenever you want to do whatever you have to do, change these numbers. Then everything will be automatically calculated. These are the things that you have to change. If you want the coupon separately, you can do that as well. No? How do you calculate the coupon? Face value into coupon frequency, coupon divide by 100 to make it decimal and frequency. You get 45 million. Clear? Is it clear? Any questions?
Sir, can I see the Excel again, sir?
Yes.
$45 million is the
Coupon.
coupon. Okay, thank you, sir.
Will there be any differences due to the day count basis on these? If it's actual by 365, 364?
Yes, that can be. That can happen depending on the period.
Okay, will we be reviewing that in future, or
What do you?
will we be doing an example of such?
If you need, we can do. Do you think it's required?
If we can do one in a different format?
Okay, we'll do that. But if we get the same example, it would give us the same number, no? Because
No.
as we discussed earlier, even for the whole period, we get 181. Yes, in between, yes. Number of days between.
If
This
we
may
take
be
2000,
yes,
yeah.
January 15th. So
if we take last year, 2020, leap year.
but even in that case, this would become 182.
From January 15th to July 15th.
Sorry. January 15th to July 15th. You are referring to 3360. Then still, yes, there won't be a difference. Yes, then it will come as 181 still.
Now, the specific one that we have done now, we need to consider that to be as actual by actual.
This way, actual, yes.
Actual, no?
Yes, the calculation that we did here, we assume actual. That's why we count actual number of days and this 136. But if it is 3360 days, what is the number of days between the last coupon date to settlement date? Because the last coupon date is January 15th, settlement date is 31st December. There will be a difference. Say January, February, March.
Still it comes up to 181 days.
May. No. That will remain as 181, but this won't be 136.
Yeah.
January there are 17.
137.
February 30, March 30, April 30, May. Since it's the last business day, it would be
May, yeah, 30. It comes 137.
130. So, because we had 2 more days from
2 days for February.
The actual one we get only 28. So then just change this to 137. That's the only difference that we get in this example. If we, yes.
So any basis will have a slight variation in our clean price and dirty price only, no?
Basically, in the dirty price and the accrued interest.
Yeah, not the clean price.
Not the clean price.
But still, whatever basis for bonds, whatever basis that we use, there is no, there'll be a minor impact in our books only. Whatever the coupon amount that we receive is going to be same, no? Anyway.
Yes. If you keep it in between two coupon periods, you get that full coupon amount.
Full coupon, yeah. Only thing there'll be a slight difference on the in our books.
No, if you keep it during the whole period, there won't be any difference. Still, you get the same thing.
Yeah, whole period in between when we purchase.
If you trade in between, then the accrued interest and things would be different. Even you keep it for the whole period. Say if you take this bond, what is the accrued interest? Then now our books are closing on 2021. Assume you keep this bond until maturity of beyond 31st December. Then you have to account for the accrued interest on this bond.
Yeah,
that will vary if you have this. You have two different bonds with two different day count conventions, but same coupon rate and the same coupon dates.
Yeah.
But there will be two different accrued interest on that in your books. Yeah.
Yeah.
Can we go back? Anything else? Okay. So then we'll come to the two words that we discussed, clean price and the dirty price. In the clean price, we don't consider accrued interest. That means we exclude accrued interest. In the dirty price, that includes accrued interest. So basically, the equation is dirty price equals clean price plus accrued interest. So now still we didn't discuss how to calculate dirty price or the clean price. We discussed only this part. How do we calculate accrued interest? Okay. What would be the price of a bond on a coupon date? Whether there will be the difference between dirty price and clean price on a coupon date?
No, because it's zero.
No, it's zero because accrued interest is zero on a coupon date. Whatever accrued up to, say, assume today is the coupon date, whatever the interest accrued up to today, that means even the yesterday's interest is accrued and it's going to be paid today. So therefore, no accrued interest. We have only the clean price. Accrued interest is zero because it will come as a coupon today. Then the dirty price and the clean price equals to zero. So, okay, I'll explain these two as well. Cum coupon and ex coupon. You might have heard about ex dividend. Have you heard about ex dividend?
Yeah.
What does it mean? So even there's the same concept for coupon. That means this is the coupon date. I put it as coupon date. This is the last coupon date. This is the ex coupon date. What does it mean? Whoever who holds the bond on this date, they will get the coupon on this coupon date. Is it clear? So the issuer, the issuer has to do some administrative work and calculate and make the payments to avoid last moment difficulties and failures. Issuers take the bondholders, say 7 days prior to the coupon date. But then whoever the owners of this date will receive the coupon on the coupon date. That's the concept of X coupon. So if you do a trade somewhere here, in between that the X coupon date and the coupon date, what should happen? Now, generally, buyer should pay this accrued interest for the seller. But in this instance, the new buyer won't get anything on the coupon date because it will be received by the current holder. In this case, who has to compensate? The seller has to pay interest for, sorry, not for that period, from the settlement date the seller has to pay to the buyer interest for this period. Why? The current holder will receive the whole coupon, even though he is selling the bond here. Is it clear?
It means that seller to forego the accrued interest, no, sir?
Yes.
Yes.
No, not forego the accrued interest, which is not belong to him because he is selling here, but he is going to get this cash flow from the issuer. So it belongs to the new buyer.
Yes, that means whatever eligible for the seller will get the new buyer, no, sir?
No, new buyer won't. New buyer, he is eligible for this part, no?
Yes.
But he won't get it. Why? Why? The issuer will pay the whole interest to this party, whoever who holds it here. So in our example, 45 million, in our previous example, this whole 45 million will be received by the current seller, whoever who sell it here. But say there are 5 days here, that 5 days interest should be received by the new buyer.
Okay, right. Clear, sir.
So the seller is going to compensate the buyer in this instance. If it is traded somewhere here, seller is going to compensate. Sorry, buyer is going to compensate the seller for the accrued interest that the seller should receive for the past period. But in X coupon event, what would happen? The seller has to compensate the buyer for the future interest. Is it clear?
the sense the rest of the portions coupon interest will not be taken from the buyer, no?
No, not from the buyer. Yes, it is paid to the buyer indeed by the seller.
Paid to the buyer in the sense, on the
settlement date.
You have marked the selling date at 7th.
Yes. Whatever this date.
Yeah, 7th.
No. This 7 is
so on the 7th when the buyer.
No. This 7 is not the date. This is the number of days between ex coupon date and the coupon date. This is not a date. So say assume after 2 days the settlement falls. That means there are 5 more days for the coupon date.
Yeah.
Whatever the interest for that 5 days, the seller has to pay to the buyer.
In the sense when the buyer is purchasing, he doesn't need to pay those 5 days coupon interest, no?
However, he's not going to pay this interest for anybody. He is supposed to pay the interest for the past.
Yeah.
He is not going to pay that. He is not going to pay any accrued interest for the history, but he is going to receive interest for the future.
That's also after the.
Yes, go ahead.
That also after the coupon date.
No, on the settlement date.
On the
after coupon date, nothing. After the, after coupon date, if now new buyer holds it, he will receive in the next coupon date.
Next coupon, yeah. So basically, what refers by this example is. What refers by this example is the buyer will have no any connection to the previous coupon, no?
Yes, he won't receive any coupon previous
coupon. Neither he will pay at his cost for the coupon accrued interest also.
Accrued interest, but he receive for his
5 days
holding period. His holding period in the current.
That also he will not receive, no?
No, the seller has to pay it to the buyer. Say this is the ex coupon date. Assume there are 7 days.
Yeah.
Then the coupon will be paid here. The coupon will be paid here. This is the coupon date.
Yeah.
There are 7 days in between ex coupon date and the coupon date. The settlement date is here. There are 5 days. Party A sells to party B. Okay.
Yeah.
This is seller. This is buyer. Seller and the buyer. Okay. Now, if it is somewhere here, settlement date for somewhere here, seller has to pay the accrued interest for this history. That's correct. Is it clear?
Seller has to
pay. So sorry, buyer has to pay to the seller. Buyer has to pay to the seller for this accrued for this history, the accrued interest.
Yeah, correct.
But in this case, on the coupon date, who is going to receive the coupon? Okay, yes.
Seller.
The seller is going to receive the coupon. This party is going to receive the coupon. Then he will receive whole 45 million, assuming the whole lot is there. But the party B is buying it here with the 5 days remaining to the next coupon date. So there's a there should be an interest income for the party B for these 5 days. Is it clear?
Okay. So for that 5 days, the
That
party
5
B will
days,
get the, okay.
the seller has to pay that interest, 5-day interest for the new buyer, party B.
Because he'll not receive the coupon.
He is not going to receive the coupon. When do you pay it? You don't wait until this. You never know whether he will pay it. So the party A pays it on this date.
So normally,
normally accrued interest is paid by the buyer to the seller.
right.
It's
Buyer to the seller, right.
Yes, it's for the history.
Right. As I know, sir, when it comes to a coupon date or prior to 1 month, we can't sell that particular security, right?
Sorry? On
If the coupon
on the coupon date or prior to 1 month, you can't sell?
Yeah. Is there any regulation like that?
I'm not aware about that. There shouldn't be.
Okay, thank you, sir.
And also,
I'll check it. As far as I know, there's no such.
Mr. Shanta, the X coupon, is it applicable in the local market?
No.
There is no such thing, no?
No such thing. I'm not sure.
I have not.
Whether there's any corporate debentures with X coupon.
Also, in other words, when the seller has to compensate the buyer, more or less he might be doing it via a price adjustment, no?
Sorry?
When the seller needs to compensate the buyer.
No. You don't do any adjustment into the price. The price is agreed. Then adjust. So that's why we agreed the clean price. We agree the clean price. They do the adjustment in the accrued interest, and the dirty price is the settlement price, what you pay or receive. That's how it happens.
Yeah. In an instance of such, in an instance of X coupon, the compensation part works on a separate note than the deal.
No, it would be the part of the deal.
Part of the deal.
Yes.
Will you be going through the clean price? Yeah, go ahead, Mr.
No, there's no reason for separate it.
Okay. Will you be going through a clean price calculation, Mr. Nishanta?
Yes.
Okay, fine.
Sir, accrued interest is received in the seller receiving the accrued interest on settlement date.
No. Yes, seller receives in a normal circumstance without X coupon. Seller receive the accrued interest on the settlement date. Yes.
Then is there any adjustment for the days between settlement date and the coupon date? Because if the seller not sell this instrument, if the seller not sold this instrument, then he received in coupon date. But
Yeah. You are referring to the time value. Yes. We ignore that time value. Yes, because say in this example, not this example. This is with the X coupon. So if you go back to this example. So if the original buyer who holds it here hold it till coupon date, he should receive the coupon on this 15th July. But now for this holding period, he is receiving his accrued interest on that day. So basically 33 million is paid by the buyer to the seller on 31st May. But that 33 million, the new buyer is going to receive it on July 15th. There's a time value in between these two. That's the part that you are referring.
Yes.
We ignore it in this. Yes, because that's a cost to the new buyer.
Okay, sir. Thank you.
Anything else? Sorry, we'll finish this one as well. Traded flat. So when there's no accrued interest, we call it traded flat. There are, say, especially on a coupon date, there's no accrued interest. So traded flat, that means only the clean price. Anything else?
What is CQM coupon?
Cum coupon means cumulative coupon. So that means we trade somewhere here. Then it's included in the include whatever the accrued interest. When we trade it here before the ex coupon date, it is called cum coupon. After the ex coupon date, it's ex coupon.
Okay, sir. Thank you.
Sir?
Yes.
Sir, it is not practiced. Ex coupon is not practiced in local market, where it's practiced in other markets. It is
there are instances, yes, even in the international bond market, say especially Australian bond market, still they use this, but now it's very rare. With the technology, you don't have to do things manual, and no need lot of time to do this. So therefore now this concept is not necessary to practice. But earlier, say when you have 1,000 bondholders, to find out who are the 1,000 bondholders and arrange the coupon, you can't do it within a day. So that's why this ex coupon comes into play. You get the list of bondholders as of this date, and you can arrange everything to make the payment on this date. But now it's almost everything is electronic form. You don't want that much of time to do that.
So it is only in theory, yes?
Sorry?
It is only in theory, not in practice.
No, still there are some because not everybody has this these facilities. Still even in international market, still there are these things applicable. The ex-dividend concept is still there. Even in Sri Lanka, I think firms use that.
So if it is not practiced, then the seller has to bear the loss, no?
No. If it is not practiced, means if this ex coupon concept is not used by the issuer, then nobody is going to lose. You just follow the normal cum coupon concept, accrued interest until this date. When you settle, the buyer has to pay the seller the accrued interest. Nobody is going to lose.
So in the ex coupon case, the seller has to pay, no?
Ex coupon case, the buyer has to, seller has to pay, yes.
So if it is not practiced, so that since the seller is not going to pay,
it's not practiced means this ex coupon, it has to introduced by it is in the agreement of the bond. So in the bond agreement, it says there's a 7 days or whatever number of days ex coupon dates, or specifically given this is the ex-coupon date. So that what does it mean? All investors, they know this bond is trading on the ex-coupon basis. So on that particular, the issuer will pay coupons to the bondholders on that ex-coupon date. So every party knows that. Based on that only, this ex-coupon is practiced. Whether seller pays to buyer or buyer pays to seller. It's not just agreement between the buyer and the seller. That has to be in the covenants of the agreement in the bond, specifically saying this is ex-coupon. So I will try to find. I'm not sure. I cannot straight away remember a bond with a ex-coupon in this sort of description. If it is a ex-coupon, it should mention here this is ex-coupon and 7-day or 10 days ex-coupon or something like that.
That is, there only we will practice that. It is in original agreement.
Practice it, yes.
Okay.
Ex-coupon in not in practice means the issuers, they don't use it now, because they can calculate the coupon and find out the bondholders very quickly through systems and make the payment. No need lot of time for the administration of these coupon payments. Earlier it was there because they need time to do this administration. Say maybe writing checks or something like that, to get the list of bondholders and write checks for them or something like that. It is not there.
Yes, sir, thank you.
Okay. Anything else?
Sir, can I see the page number 24, please? Page number 23 also same, no, sir?
This is the issue is different. This is General Electric. That's a US Treasury.
Okay, sir. Thank you, sir.
Okay, shall we take a break here? And we'll quickly discuss this participants. It's not a big thing. And so do I have to explain? Indeed, I don't think. Who are the participants in fixed income markets? All these parties are there as issuers. Then as investors for different perspective, and intermediaries, some intermediaries and other parties, primary dealers, broker dealers, investment banks. In primary dealers, they may participate as investors as well. I missed it here. And as intermediary as well. Credit rating agencies and parties like this, they help investors to find out details of the creditworthiness of issuers. Investment banks, they help both issuer and the investor, helping the issuer to structure the product in a proper way and to decide the price and the coupon rate, or what is the period of the bond that they should issue, depending on the market condition and the requirement of the issuer. On the other hand, they will market it for the investors, and the investment banks, they will try to find a suitable investor for this bond to cater the requirement of both the investor and the issue. That's what would happen. If you really need, let me know, then I'll go through these. Otherwise, I'll start with this topic, valuation of FIS. That means how do we calculate the price of a bond, and when we use this, whether this is the clean price or the dirty price, and how do we derive the other component. So we'll take a small break here, about 15 minutes, and then come back. So any questions? Okay, if you don't have any questions, we'll move forward. As I mentioned earlier, the price of a bond equals the present value of cash flows received by the owner of the bond. So that means owner means the buyer or the investor, whoever holds it. The price is the present value of future cash flows coming out from the bond. So you know how to calculate the present value of a single cash flow or a series of cash flows. So in different times, there can be different cash flows. Then depending on the time and the required rate of return, what you have to do, calculate the each and every cash flow. In a fixed coupon bond, the coupon amount is fixed, that we know. Every year or every 6 months or every quarter, we know what's the cash flow that we are going to receive. We need to know what is our rate of return, required rate of return. Then discount all the cash flows based on the required rate of return. So remember, the last cash flow comprise two components. What are those two components? The last coupon and the face value or the redemption value, whatever you call it. So there are two cash flows on the maturity date, the last cash flow. So what you have to do, calculate the present value of each and every cash flow and sum them up. Then you will get the price. But this is the basic method, fundamental way of doing it. Assuming different cash flows, discount it and add them up. But in a fixed coupon bond, there are fixed cash flows during the period and at regular intervals. So we can consider those coupon payments as an annuity. You know what's an annuity. So, and you know how to calculate the present value of that annuity. So this part, this first part is the present value of that annuity, coupon, present value of all the coupon cash flows. But remember, there's another cash flow. What is that? There's another cash flow remains there. What is that? That is the face value or the maturity proceeds. So we have to discount that as well. So calculate the present value using the annuity equation of all the coupons, add the present value of the face value to that, then you get the price. So you can use one or the other method. But if the coupon payments are not fixed, then you cannot use this. Then you have to go back to the basic. Different cash flows, discount, and add them up. So that's the basic. Any question? We are going to do few examples.
So can you explain the page number 34 again?
Yes. So basically, by definition, price of a bond is the present value of future cash flows. That's the basically, I mentioned this earlier as well. Any financial instrument value is like that. Present value of cash flows. Most of the financial instruments, bonds, shares, and these things. So what this equation says, there can be different coupons in different times. It may be generally in regular intervals. So C1, C2, C3 up to Cn represent different coupon payments. 1, 2, 3, N is the timing. 1 period time, 2 periods time, and 3 periods likewise. R is the required rate of return. So you calculate the present value of each cash flow. What is the cash flow received after 1 year's time or 1 period time, you discount it for 1 period. The second cash flow that you received 2 periods time, so you discount it for 2 periods. Likewise, all the cash flows you discount and add them up. What is this last one? Face value, because on the maturity date you receive a coupon plus the face value. So you can consider them as two different cash flows and discount it back. Is it clear?
What this stands for? I
is this timing. Whether C1, C2, this is I. I goes 1 to N. So coupon period for the period I. So C1 means coupon payment for the period 1. C2 means coupon payment for the period 2. Likewise.
Thank you.
Sir, I'm sorry.
Yes.
So the price is the cash flows, the discount at present value, right? The present value of the future cash flows, right?
Yes.
So why do you have to it would be same as getting this in future, right? I mean, you pay a price today, and that is same as the your entitlement that in future, right? I mean, so why do you have to pay same thing and get the same thing? You're getting the same thing, right? I mean,
yes, this is the fair price depending on your required rate of return. Practically, when you do that in the market, there may be instruments which are underpriced. So what is the price that you ready to pay? There may be bonds or instruments in the market. The price is less than that. Then you try to buy that. Then you will get an extra return on that. In that sense, when you make an investment or make a manage a portfolio, you try to do that.
okay.
That's one thing. On required rate of return is reflected everything. What do you think about the future interest rate movements? What is the interest that you foregone? That all everything is factored.
So that is the perception, right?
Yes.
Your perception of the.
Yes.
So
Good question. Yes, but that's the way how markets behave. In that economic sense, you don't get anything. Yes, true.
Okay.
On the same question, Ms. Nishanta, now that is where if we are getting something below the market rate, that is where this discount and premium bonds comes into play.
Not necessary.
It doesn't reflect that.
No. Discount and premium, it's nothing to do with. It's not. Yeah, it depends on the market rate and the coupon rate. It's not the two different investors require two different yield or the required rate of return. It's not that.
It's not that.
Even the same bond, depending on your requirement rate of return, two different discounted prices. So if you can buy at a lower price, the better that you earn more return in the future. When you decide the required rate of return, you price everything, whatever the inflation, then interest rate movements that may come into in the future. You forgo your liquidity, that you need compensation on that liquidity, what we call liquidity premium, the risk that you take, credit risk, you add all those things into this required rate of return. Based on that only you calculate the price that you are going to pay for it. In a market, different investors, they may have different views, so therefore there can be different required rate of return and different prices. But ultimately what happens, market forces bring all them into a single price. Otherwise there will be arbitrage opportunities and ability to make money quickly. You can buy from a party who's willing to sell at a lower price and sell it to a party who is willing to buy at a higher price. When you try to do that, when the demand is there to buy, price will go up. When there's a demand to sell, price will go down, and it will settle at a particular level. Demand supply theory, market forces, that would happen. So because of that, for a particular issuer, since you need, say, you need 10% rate of return, you may not be able to go to the market and buy it at 10% with a 10% return. If the market gives only 5% or 6%, either you have to take it or leave it. Anything else? So shall I move forward?
Yes, remove the calculation.
Okay. So I hope you can remember this equation. This is the present value of annuity. Same cash flow at regular intervals. So either way, you can calculate the present value of cash flows. So this is an example. In this example, you can see settlement date is falling on a coupon date. If the maturity date is 15th December, then all the coupon dates, whether it's annual coupon or semi-annual coupon dates would be on 15th December. So we are going to price a bond on a coupon date. And in this example, coupon frequency is annual. We have two percentages. One is coupon rate, that is the interest rate agreed by the issuer to pay on this face value. The required rate of return is the return the investor requires on this investment. So to discount the prices or discount the cash flows, we don't use the coupon rate. We use whatever the required return by the investor. So now we have two different rates. Coupon rate, that's the interest rate the issuer agreed to pay, and the required rate of return, what is asking from the market or the investor. Sorry, what is asking by the investor from the issuer. So go back one of these equations to price it. I'll first explain using the basic formula. So whenever you want to price a bond, better to follow these steps. First, determine the cash flows. What are the cash flows and when we are receiving these things? First thing is, in a fixed coupon bond, cash flow is, most of the cash flows are coupons. So we have to calculate what is the coupon. In this example, 1 million face value, 5% coupon rate. Don't get confused. There are two rates, 5% and 5.25. When you calculate the coupon, make sure that you use the coupon rate. Divided by anything else, because the coupon frequency is 1. It's annual coupon. So the coupon amount is 50,000. Then what are the timings? So make it a practice to draw a small timeline and mark it on that, mark cash flows on that timeline. The first one, what is the settlement date? December 15th. Then the last date would be this one, maturity date. Every year, December 15th, there will be coupons. So these are the coupon dates. Clear? Is it clear?
Yes, sir.
Okay. Then even though I put dates here, it's not relevant for us in this calculation. What we need is time period, whether it's 1 period, 2 period, 3 period, or 5 periods, like that. So that's what we need. Time equals 0 on the settlement date, time is equal 0. Then the next coupon, after 1 year time, in this case, we consider it as 1 period. Whether it's a 1 year, whether it's a month, or it's a semi-annual period, it doesn't matter. What is the period? 1 period, then 2 periods, 3 periods, and 4 periods. In this bond, there are 4 future cash flows. So in 4 different time periods, but equal length. It's not unequal length. It should be in equal length. So we can consider 1 period in between any cash flows, the same period, whether it's a month or a year or a quarter or semi-annual. But in this case, it's 1 year period. In between 2 cash flows, there's a 1 period. So first year, second year, third year, and fourth year. But again, I am highlighting that we don't care whether it's years, semi-annual periods, or months, quarters, nothing. time periods. First period, second period, third period, and fourth period. Then the cash flows. At the end of each and every period, there will be 50,000 cash flows. What are those? These are coupon payments. But at the end, on the maturity date, the issuer will pay principal amount or the face value plus the coupon. So therefore, the last cash flow is 1,050,000. Now the required rate of return is given 5.25. What do you have to do? Discount this 50,000 for a one period at 5.25. 50,000. Discount the second cash flow 50,000 for two periods at 5.25. Likewise. So what you get in that 50,000 divided by 1 plus 5.25 over 100. So this is how do you calculate the present value of this 50,000. This is only for a 1 year period, but the second one you have to discount it for 2 time periods. What you should get here? Can someone write and let me know?
$50,000 divided by 1 plus 5.25 divided by 100 into 2.
Yes,
power 2.
Into means to the power 2. Whatever in the denominator to the power 2. So likewise, you do the third cash flow and the fourth cash flow. The fourth one, if you need, you can divide it into 2 and do it separately as mentioned in the original equation. So now, once you calculate present value of each and every cash flow, what you have to do? Add them together. So then we call it, you should get this. Try it and let me know whether you got this number. Is this correct? Did you all get the same number? Oh. Any different answers? Please let me know, then we can discuss.
Got the same answer.
You got the same answer. Okay. Any different answers? No. Then let me know whether it's clear, or you want me to explain it again. If not, we'll move into the next one.
Excuse me, sir.
Yes.
Yeah, don't we consider any transaction cost?
No.
Broker commission or something?
No. You can't add that to the price. That's a cost. That's a transaction cost.
Okay.
You don't pay it to the seller. That transaction cost, it's a different thing. The price is the price that you agree with the buyer. Sorry, seller or buyer, between you. Okay, then this is the fundamental way of doing that. The other one is, this is also a fundamental method. So we can see these coupons as these coupons as annuity payment with regular intervals, flat cash flow, 50,000 cash flow. So we can consider these 4 cash flows in 50,000 each as an annuity. Then we can calculate the present value of that annuity. This is the equation to calculate the present value of, use that. Then if you use that, we miss this face value part, which we are going to receive in 4 time periods, after 4 time periods. So we have to calculate the present value of that face value as well. So discount this 1 million or the face value for 4 time periods. So that's the component here. What is N here? What is N in this equation now?
Number of discount periods.
Number of discount periods. But in this case, what is N?
4.
4. So this is in both equation, N is 4. You don't want to worry about 1, 2, 3, because this is the annuity equation. What we need, the ultimate time period. What is C?
50,000.
50,000. What is R?
5.25.
5.25%.
25.
You can substitute all those figures. This is for the annuity part, and this is for the face value part. If you solve this, you should get the same answer. Any questions? Any questions? No. Then I'll explain how can we do this pricing in Excel. Again, we can use different methods. First one is on a coupon date, what we discuss on coupon date and with annual coupon periods. So shall I show you from the scratch? What we need face value, coupon rate, coupon frequency. What else? Rate of. These are the things we need. In this our example, what is face value? What is the face value? 1 million. Coupon rate is 5%. I just put it as 5. Coupon frequency 1. Maturity is 4 years. Rate of return, required rate of return 5.25. So then we'll do time and the cash flow. Time starts from 1 for 4 periods. The cash flow, the coupon amount, face value into 1 plus coupon rate divided by 100 into coupon frequency. That's the coupon. The problem here is this. Sorry, we need coupon, so we don't want the 1 plus. Face value, coupon rate, divide by 100, divide by 100, and the coupon frequency. Is it clear? So 50,000 coupon. These two are fixed. Coupon frequency also the same for each cash flow. We get 50,000 cash flow in each time period. But remember, on the maturity date, is it correct, this one?
No.
No. What's this here? We have to add the, we should add the, add face value. I'll fix that. So these are the cash flows. Then what we have to do, we have to calculate the present value of each cash flow. How to do? Cash flow divided by 1 plus. Now we have to use required rate of return, divide by coupon frequency and 100. Correct? E6. So these are the present values. Then the price is the sum of these. Something wrong. This is not the answer we got.
The present
Factoring
values
is
are
wrong, sir.
same for all those.
Yes, sorry.
Factoring is wrong.
We have to
To the power.
to the power time.
So discounting factor cannot be the same to the period.
What do you mean? No, this is the
No, sir, the second year it has to be power 2.
But
no.
that was
I didn't fix it. I didn't fix it. So it should change with this. We'll put a bracket here. That may be the reason.
There's probably an issue with the order of operations. Maybe we might have to.
So you can put power to the timing.
That's what I did. Power to timing. See, V12. This the. You mean use the power equation? We'll do it.
So that power should be for the entire factor, right? The
Yes. So basically, cash
maybe
flow
put a bracket there.
divide by 1 plus. Then what we need 5.25 divide by frequency into 100. Better to put a bracket here. Close that bracket and put the power. Correct. Then divide 1 plus.
Shouldn't that bracket be
No.
1 plus?
Yes. 1 plus 1, 2. Now the bracket is there. Okay. We have 3 brackets open. I have closed only 2 brackets. Yes. That's the problem. Now fix these cells. Is it correct?
Yeah.
Now correct, sir.
Correct, no? We have this 99186. Okay. Now, so that's one way. You can go to the basics and do it. But that's the thing. The order, and when you put brackets, you have to be careful. The other one is, instead of doing that, if you can use the annuity equation here, type it like in that way, calculate the present value of annuities. That means first thing we need 50,000 divide by this one, but you have to divide it by 100 as well. Then better to put a bracket here, then multiply by 1 minus 1 over 1 plus r divide by 100 again, the power 4. Again, something wrong.
Probably we can get the factor separately and then use another
Yeah,
formula.
that is also possible.
It's confusing.
No, what is missing here? What's wrong?
This is correct. This is correct, sir. We have to add the principal.
That's the thing. Now we have to discount this face value. Better we'll put another bracket here. Face value by I think we should get, yes. The first part of the equation, before this plus sign, this is only the present value of the annuity. The second part is the present value of the face value. So altogether you get this. So in Excel, you don't want to do this much. There's an easy way. But for that, the information that you have to put it is different. You need settlement date and maturity date, and what is the settlement date here? December 15th, 2021. What was the maturity date? December 15th, 2025. Is it correct? Yes, otherwise. And what is the rate you need? 5.25. Then there's an equation called price. What are the parameters? First you have to give the settlement date, then the maturity date. Sorry.
We need the coupon.
No, in Excel, the rate is called is for the this is the coupon rate. Coupon rate. Then our required rate in Excel, or even in future, we are going to call it as the yield, 5.25. If I remember, we have to give this in decimal places. We'll try. Yes. Price, settlement date, maturity date, rate, that is the coupon, and the yield. And the next one is tricky. Redemption. In Excel, so the face value is considered as 100. You have to give it as 100. I don't know why then they are asking it without taking it by default. Then we can give the coupon frequency. Now in this example, coupon frequency is annual. Then what is the day count basis? So we use actual. So this is not given properly. You have to give this in decimals. Now you get something 99.1186363 likewise, but because this is, as we mentioned, generally we quote the price as a decimal. Now in this example, price didn't come as a decimal. That's the problem, but really it has to be the case. So in that case, we use face value as 100 without putting cash flows in this whole amount. We calculate everything in terms of assuming face value is 100 and do the calculation. So this is what we get. This is the price for the face value of 100 bond, but our face value is 1 million. Then to get the correct price, what we can do? Multiply this by this. Not only that, divide by 100. Why did we divide it by 100? Because this is a price as a percentage. Price as a percentage of its value.
So here that means price means when you purchase the bond, you need to pay only 991 plus, no?
Yes.
Yes, instead of 1 million.
Instead of 1 million, yes.
Yes, that is because your return is more than 5%.
5%, correct. So that's the relationship that we have to identify.
However, at the end, as a maturity, you will get the 1 million, no?
Yes. That's the difference between price and the face value. That's why so what's the amount that borrower borrows now? It's only 991,000.
Yes.
This thing. That's why I didn't mention that face value as the amount that the borrower borrows. It's not. Face value is the amount that the issuer or the borrower is going to pay on the maturity. The amount he received when he's issuing the bond would be different. That depends on the market. What is the required rate of return of the market? Depending on that, he will get maybe exactly the same amount, or maybe less than that, or maybe higher than that.
At the same time, you will get the coupon payment of 50,000, no?
Yes, yes. You get the coupon. That's based on the face value and the coupon.
Yes.
But by that, say, assume by the time of the first coupon, interest rate is 10%.
Yes.
Nothing to do with that. Still, you get at 5%. The 50,000 coupon. Is it clear now? How to calculate the price? But in general, since, as I mentioned, the price is quoted as a percentage, we don't use this 1 million or 10 billion or whatever the whole face value. We use it as 100. So in this case, so we'll put here 100. Then you can see the cash flow. Coupon would be, because 5% coupon, cash flow will be 5 rupees or $5 in each cash flow. And on the maturity, we'll get 100 rupees plus 5 rupees. So then this is the price, but better to get it for more than at least 8 decimal places, because when we multiply it by millions and billions, it would become a huge difference. You can realize it. If we use 99.12 and multiplied by 1 million, we get this, I forgot battery. So what's the difference? Now if we multiply this by 1 million, $1,363. So it's a big amount. So you cannot forego on this. So therefore you should not do rounding off. Clear? Even we use for small figures because it's easy, use it 100 and small numbers. And the practice in the market, you might remember in this. The price is quoted in that way. So if you want to calculate the total amount consideration that you have to pay for 1 million, that you have to multiply this by 100 like that. So you have to do that. Clear?
Can you double click the cell B19?
B19. Where is this one? Yes.
Price calculation.
This is the equation.
You have put frequency 1. Basis also you have put 1.
1. Yes, that's actual. Is it correct? Yes.
How do you get the basis weave?
Sorry?
In Excel, how do you get the basis weave?
This weave, no, yeah. When you type it, it will automatically come. One is annual, the frequency. You put the comma, then this appears. Just click on this. Is that what you ask?
Yeah. I think due to my Excel version, I don't get that drop down.
No, it should. Yes, sometimes that happens. You just press escape and type it from the beginning. Most probably it will get again.
Oh, okay. Anyway, it gives the feed, no?
Yes. Generally, it gives that.
Yeah. And also, the rate of return is 5.25, no?
Yes.
The rationale on where the rate of return came is not material, no? For each buyer, if I want, I can expect a rate of return of 6% and do the calculation likewise, no?
Yeah, yes, you can do that, but only thing is practically whether you can go to the market and find it at that rate.
Yeah, that is a problem. So it depends on the market yield,
market conditions. That your estimate would be reasonable, should be reasonable, based on the market conditions. So basically, say take government. Now government yields that now maybe most of the banks thinks the interest rate should be at a higher rate than this yield.
Yeah.
But you cannot, for whatever reason, you cannot. So now you have to come up with within that given range, come up with a reasonable rate. That's how it works.
Can we go to slide number 34, please?
Yes. Someone wanted to ask something.
You wanted to go to the slide number 34, no?
Slide number 34. Is it okay?
Yes, and also the calculation that we did in the slide, I think 35 or 36. So just can you
36. No, this is just the cash flow and the coupon. This one.
Yes, yes, correct.
So I can think about what you are trying to do. You just try to note it down. So I gave you enough time. Don't do that yet at the end, but try to do it by yourself and compare it with this. When you do by yourself, then only you will realize what are the mistakes that you are going to do. It's not necessary that you have to write it like this. If you can straight away write it as 1.0525, then it's fine.
Yeah, I made a mistake in the last T4. That's what I just want to double check with it. I didn't get the answer. That's the reason.
Maybe either you miss 4 or not divide by 100 or miss the face value. Those are the things. And remember, this is not 1 minus. Everywhere 1 plus. You might find some equations with 1 minus. Is it okay now?
Can we just go to the Bloomberg image file? I don't know the page number.
Which one? The Sri Lanka?
Not the Sri Lanka, the US.
This one or this one?
This previous one step back. Sorry, it should be the Sri Lankan one. Sorry. Here the price is above 100 is because the coupon rate is 9.8 and the yield is 6.6. Lower than the.
Yes. Okay, we'll come to that. So now you can see the coupon rate is 5. Rate of return is 5.25. That means rate of return, the yield, we call it yield, is higher than the coupon rate. Then the price is less than face value 100. We can check it. What would happen if we increase to 5.5? What do you expect? If we increase this,
it's below.
Yes, if we increase the rate of return, price would be lower. Not it 99118. It would be 98 something. So what would happen if we go the other side? Price would increase 99.64. You can see earlier it was 99.118, now 99.64. When the what would happen if the rate of return is 5?
It will be the same 100.
It will be same as the face value. It will be 100. This is the best thing whenever you do this sort of calculation. Whatever the yield given, forget about. First put yield as the coupon rate, then see whether you get 100. Then your calculation is correct. Otherwise something wrong.
Yeah.
Then you put whatever the asking rate.
That also, if the issue date and the settlement date is the same, no?
Yes. So we are not going to change all those things. And this say the way that I did here, I didn't worry about the settlement date or the maturity date or the issue date.
Yeah.
Nothing. Only thing is we assume settlement date is on a coupon date.
Yeah.
Then we have the full coupon cycles.
Yeah.
All cash flows we are receiving in exactly one period time, whether it's a 1 year, one semi-annual period or whatever. It's not in between two coupons. So when we do that this manner easily, no need to worry about the settlement date or the maturity date. But for Excel to get the coupon dates and the timing properly, Excel needs this. Not only that, when I calculate this, I didn't worry about whether it's actual. But Excel it's need because the same formula you can use it for a in between for a settlement date in between coupon.
Yeah.
That's why Excel needs the day count basis. We'll discuss that later. So, however, what I wanted to highlight, when the rate of return, required rate of return or the yield increases, price decreases. You can see it straight away from this equation as well. So, whenever rate of return increases, the denominator are higher. That means present values are lower, then the sum is, or the total also low. So the price goes down. Price and the yield or the rate of return, there's a inverse relationship. So now we saw what is the price at 5.5, what is the price at 5.25, what is the price when the yield rate of return is 5, what is the price when it is less than 5. Now you can see price is higher than the face value. This is the premium. The bond is trading at a premium. In earlier case, when the yield is 5.25, it's at a discount. So when it's exactly 5, it's at par. We call trading at par. We don't say trading at flat, we call it trading at par, same as the face value. So this is the relationship between price and the yield. Yield increases, price decreases. And what is the relationship between price, yield, and coupon rate? When the coupon rate is greater than the yield, when the coupon rate is higher than the yield, then the bond is trading at a premium. Say 4.75. Coupon rate is 5.15. So basically, coupon is greater than yield. Then bond is trading at a premium. When coupon equals yield, the bond is trading at par. When I change this to 5%, you can see price is par. When coupon is higher than, coupon is less than yield, then the bond is at a discount. So these are very important relationships that you should know. So whenever you do a calculation, even before you do a calculation, you should know whether your answer should be less than 100 or above 100 or at 100. So if it is the same, you no need to do any calculation. If the coupon rate and the yield is the same, you need not to do any calculation. You can straight away say its price is par. If the yield is higher than the coupon, then you know it should be less than 100. If you get a price higher than 100, that means something wrong in your calculation. Clear? Any questions?
Now, sometime back, the interest rates were, sometime back in the sense before like 2 years and all, the interest rates were better, and now the interest rates are a bit low. So a bond issued at that time before 2 years, if I go to trade it now, those will be more or less considered as premium bonds at this moment, no?
Yes, most of almost all everything is traded
in premium bonds, no?
at a premium now. Yes, because they are carrying high coupon, and the now the required rate of return or the yield is very low.
Yeah, very low, and the reason for that is, as you said, inflation, the market conditions, everything depends on the rate of return.
Yes. Anything else?
Thank you.
So then the next. The next example is the same thing, but I just changed the coupon frequency. So here we consider a annual coupon. So in the next one, it's a semi-annual, face value 1 million, coupon rate 5%, maturity December 15, 2025, settlement date 15th June 2021. Still you can see 15th June is a coupon date because settlement cycle goes in December and June every 6 months. Required rate of return is 5.25. So what you have to do, first calculate the cash flow, that is coupon. Now the coupon is not 50,000. Why? It's a semi-annual coupon paying bond. Coupon rate is still 5%. That's true. But the coupon frequency is semi-annual. So you get half of it in a one go. Then how many cash flows?
8.
It should be
8 cash flows.
Are you sure? Settlement date is June 15th, not December 15th in 2021. So we have a 2021 cash flow as well. So therefore there will be 9 cash flows. So how do we decide? This is the settlement date, then the maturity date, come back every 6 months. December 15th, 2025, then the previous coupon date, what would be the what's the coupon date
50,
just before the maturity coupon? It would
15th
be
June 25.
2025. It's 15th June 2025. Then one earlier than that, it would be again 15th December, but 2024. Likewise, there will be cash flows. So this is 15th December 2021. You come back 6 months, it will be exactly on the settlement date given. Clear? Again, as I mentioned, I don't worry about these dates. Now what I worry about, how many periods. So t equals 1, 2, 3, 4, 5, 6, 7, 8, 9. There are 9, but these periods are semi-annual periods, not annual. In the previous case, there were 4 time periods, annual time periods. Here, semi-annual time periods. And the cash flows. This is the first thing that we have to do. Clear? So this is summarized here. All the cash flows with the timing. Now can someone tell me what is the present value of this? Now what we have to do, calculate the present value of each and every cash flow and add them up. What is the present value of this very first cash flow that we are going to receive in 6 months time. How do you calculate? Just tell me. How do you calculate it?
So 25,000 divided by 1 plus the rate divided by 2 into the power 1.
Yes, that 5.25 you have to divide it by 2. So this is the way that you do. I didn't put each and every here. So there should be 9. Remember, the key is you have to divide 5.25 by 2 because 5.25 is the annualized annual yield. But now we are referring to semi-annual time periods. So the applicable rate is half of the annualized rate. So remember that. That's another mistake that you do. If you don't do this, it will be at a deep discount. The answer will be somewhere 70 or 80 rupees.
What was that deep discounting terminology?
So if you don't divide this by 2, you will get the price something 800,000 something.
Okay.
So the mechanism is clear for you, no? So now, see, there's a mistake. Huh? If you write it as it is, you won't get this answer and you will be in trouble. This one, it should be 2.625. Clear? Shall we move into the Excel? So here you can see face value is 1 million, coupon 5%, maturity 4 years. I just put a note here, semi-annual, because in this you can do that, but however you have to do it manually, these cash flows, instead of 4 cash flows in the earlier case, now you have to put 8 cash flows, put this manually, but you can calculate the cash flow like this: face value, coupon rate, divide by 2. But this can be put it into a template like as I did earlier. Put another row, what is the frequency, you change only there. So first 7 cash flows, only coupons. The last one, coupon plus the face value. Then discount.
There's 9 cash flows.
Yes, this is not done for that one. So in our example, there were nine cash flows. This is the last cash flow with the face value, present value calculation. This is the key. You have to divide this by 2. Then this is the total of all present. Remember, for you to understand this, I use this face value and the cash flows like this, but generally we do it for 100 face value. Then this comes as a percentage.
So do you like take it generally for 8 decimal places when that happens?
Yes.
Okay. So
At least indeed in markets there are conventions that you go for 8. Most of the time it's up to 8 decimal places.
that may be why US are representing as a fraction, so you can just get it divided, right? I mean,
It's still the same.
yeah, but if you get a fraction, then you'll get more accurate value, right? Than getting a number with a decimal some
No,
sort
no,
of.
no. You can't do this calculation with that fraction.
Okay.
Say if the price is given like 99.15, how do you use this calculation? You can't do that. That's because of there are some other historical reason, because the origin was coming from France or somewhere. They use this 30 seconds for some their calculations. That's why.
Okay.
It's not for purely for any
Calculation purposes.
calculation paper or practical reasons, technical reasons, not. Okay, is it clear? Oh, we can do the same thing. Now again, we need that. I'll go to this one. Settlement date is now instead of December, June. Coupon rate is correct. Required rate of return is correct. But what we have to change here? The frequency, it should be semi-annual. You get the same figure.
So is that the bond calculation formula in the Excel?
Yes, that price.
Oh, okay.
Okay, any question? Is it clear how to do the calculation?
Page number 41, please, sir.
Hello, sir.
Yes.
So when the compounding periods are increasing, like semi-annual or if it's monthly, so what is the relationship between the yield and the coupon rate? Are there any point which is
No
coming
relationship between yield and the coupon rate, depending on the coupon frequency.
if the coupon frequency are increasing?
Coupon rate is decided by the issuer mostly, but that can be done independent. That depends on the issuance process, but mostly by the issuer. There can be market-driven coupons. That's why in that General Electric one, the odd coupon figure comes in. that can be, but it does not have direct impact from the coupon frequency. They will consider if the coupon frequency is high, your effective rate is high. When you, that is again in terms of yield. So so you can see whether it's a semi-annual coupon or annual coupon, within a 1 year, this issue is going to pay only 50,000. Did you see that?
Yes, sir.
Because coupon, the annual coupon, you just divide it by the frequency, then you get the coupon for the for that particular coupon period. But in aggregate, what is the cost or what is the coupon payment, interest payment that the issuer is going to pay within a 1 year? It will remain at 5%, 50,000. If you divide it by 4, this will be 12,500. Still, for a year, it will be only 50,000. So there's no cost to the.
No, sir. When we discount it more times, I think the amount going to be more or less, no, sir.
That will have an impact on the price, not on the coupon rate or the yield. The coupon rate and the yield is given, and whether the price, what would be the price on the coupon frequency?
Yeah, I got it, sir.
Okay. Let me see. In this earlier, there was only 8. (991) So now you can see these two are same. Face value 1 million, face value 1 million, coupon 5%, maturity 4 years, maturity 4 years. Yield is 5.25, yield is 5.25. Only thing is coupon payment, this is annual, this is semi-annual. So annual coupon you have 4 cash flows, this is the price that you get. In the semi-annual cash flows, you have 8 cash flows, this is the price you get. You are referring to this.
Yeah, we can get it as a profitability going to be profit. What we getting as a return?
Yes.
There's 100 difference.
Yes. Because you invest only this much, and you earn a return at 5.25 semi-annual. So your effective annual rate is high.
Yeah. Okay, sir. Okay.
But that's true only if the market yields are the same. But generally it won't happen, because if this is the case, there will be an arbitrage. You buy one bond and sell one bond, match the cash flows or something like that. You can do some interest rate products to because in these two, in this one, effective annual rate is more than 5.25 because you are getting it semi-annually. Effective rate is more than 5.25. Here it's 5.25. So this is cheap to buy in that case. Those things will be adjusted. Yes.
Yes, sir. Okay. Thanks.
So practically what would happen if these both bonds are in the market, you might not find the yield of 5.25 in this bond. It may be something different from this one. Somewhat different, yes. But not by a big amount, by a small amount, because investors think about the frequency of the cash flow. but it won't have any impact on the coupon. Coupon, if it is a fixed coupon, especially coupon is fixed. Anything else? So this is how you do it with the annuity formula. Remember now, there are 9 cash flows and the cash flow is only 25,000. And again, this R, now you have to put it, this R is for a period. Now the period is semi-annual, so it like this 5.25 divided by 2. Is it 2625 or 265? It should be 265. Yeah. 26. Sorry. 2.6 in the decimal form. Yes, correct. This way is easy because you don't have to do a lot of calculation. This way is easy. This will save your time, but when you key it into a calculator or somewhere, you have to be careful. But in this case, you can calculate 2 different components separately and add them later. That can be done. First, calculate the present value of the annuity part, note it down or put it into the memory of the calculator, then do this, then add 2 figures. That can be done. Anything else? Is it clear? Bond calculation on coupon dates. So far we discussed how to price a bond on a coupon date, but it's a very rare thing. Mostly you do it on a non-coupon date. We'll discuss that later. So this is an exercise, not an example. You can do this calculation and see whether you get this number. This one. This is the where I just wanted to show you that when you have the same time period, coupons with coupon annual and annual coupons and semi-annual coupons, what would be the impact? The price is slightly lower in the semi-annual. So try it at home by yourself. And this one, which I showed to you. Then from next week, we'll start this one, how to price a bond between coupon dates. So to do that, first you have to master what we discussed so far. So is there anything before we stop here?
So page number 42 and 43, please.
42. You can't put dots. You have to do calculation for all other cash flows. I have done only 4 cash flows. There are 9. So you have to do other 5 and get the answer.
In here, only that error came, no, sir? 2.6. Point.
Yeah, it was earlier. 5.25.
43, please, sir.
Sorry?
Page number 43.
43.
Thank you, sir. Thank you, sir.
Okay. Anything else?
Excuse me, sir. So, what
Yes.
are the financial instruments in Sri Lankan market which we can apply these calculations?
This calculation, bonds, government bonds, and corporate debentures if you want to trade in between, and even to calculate the economic value, or what is the current value of your loan portfolio, which have all the cash flows, and you know the what is the required rate of return, what would be the current market value if you want to trade it. You can calculate that, and the same concept you can use in value in equities. There's a cash flow method. If you know the cash, you forecast cash flows of a particular share, then you calculate the required rate of return, then you discount. The same concept, but the way of forecasting cash flows, and in a bond it's straightforward. Even in a loan fixed with a fixed interest rate, it's straightforward, but others it may not be that much straightforward to calculate the cash flows.
Thank you.
So in the assignments, as I asked in morning, organization structure mean you asking the macro picture, no?
Yes.
Okay, okay, sir.
Anything else? If not, shall we stop here?